Good morning and welcome back to Almus Market Mornings. As we enter the weekend, the optimism with which we started the week seems to have dimmed a bit. The attacks by the Houthi rebels have kept markets uneasy. The large-scale attacks against the Yemen's government in the southwestern region in Saudi keeps fears alive for the widening of the conflict. Yields are holding comfortably above their key levels. As JK had mentioned a few days back, there is limited fall in yields expected due to the inflation being more broad-based. Today, the focus would be on the employment numbers from the US, the non-farm payrolls, and the unemployment rate, which are significant numbers and determine the focus of the Fed. Good morning, JK. How have the precursors to the employment figures been this week? What are we expecting from the NFP and the unemployment rate today?
Yeah, good morning, Swaraj. Yes, we had quite a few preliminary indicators to the jobs data this week, and they've all been nothing extremely, I would say, neither weak nor strong. Mixed indicators, in fact. Joel's data showed job openings were lower, but not too low. ADP was slight disappointment. 80,000 was expected, and we got 44,000. And yesterday's job cuts data, that is challenges job cuts data, was showed much lower job cuts by the employers at 33,429 compared to 46,000 that was seen last month. And this number is the lowest in the last 2 years as well. Layoffs are in specific sectors, particularly related to tech, and whereas other areas are seeing actually hiring, better hiring as well. Yeah, the jobless claims are also below 200,000. So that is again a positive factor. So I think employment situation is not too strong, but not too weak also. That helps Fed to focus on inflation and not to worry about unemployment led the slowdown in the growth. In fact, what we have seen is that yesterday in one of the interviews to Financial Times, Kevin Walsh actually, in a way, conveyed a hawkish bias and made it clear that September is a very much alive meeting, and this is the first time market has got any such clues from him. And his message is that if the CPI and PPI reports coming next show inflation stubbornly remaining elevated, the Fed is prepared to raise rates in September. And he also said that inflation is still well above 2% objective, and that the Fed must preserve its anti-inflation credibility. So the markets have taken that as a hawkish sign. In the meantime, apart from that factor, the return of uncertainty to the Middle East agreement on reopening the waterway has again started to haunt the market. The major sticking point remains who controls the shipping and whether Iran can levy transit fees and the sanction-related issues from the U.S. side. U.S. Continues to insist that the strait remains an international waterway and free navigation should be allowed. There should be no tolls or transit fees, which Iran is not agreeing to. Iran is not agreeing to because they want US to yield on the sanctions part and relax the ban on export of Iranian oil to the world. I think these negotiations are going on, and the uncertainty has led the oil to again move up by about 4% overnight, and other risk assets are also kind of pausing now after having seen a strong rally. And as you also referred, Saudi intelligence has, report that Iraqi militants coordinating with Houthis are preparing an imminent attack on Saudi Arabia under guidance of Iran's Revolutionary Guards. So they are also preparing for these attacks. So overall, the situation is much. I would say much concerning compared to what it was a day or two ago, and that is actually reflected in the markets. And another point is that the dollar index, is once again near 100, having gone as low as 99.50, which is again driven by dollar yen, which has bounced strongly to 158.50. We can recall that it had gone as low as 155.30 when Bank of Japan intervened last week, supported by the US Treasury. And not now, what we are observing is whether it's another failure of intervention and whether it leads BOJ to resort to other policy tools. One alternative could be to have a coordinated intervention enrolling other G7 central banks or resort to a interest rate hike. Now, in whatever they do, markets are now much bigger compared to what we have seen in the earlier days or earlier years, and even intervention in excess of 100 billion is not able to achieve the central bank's objective. So market turn when they find that the fundamentals are changing, and in case of Japan, it's still debatable whether the fundamentals are shifting for the better, particularly on the fiscal side. So that is where, and of course, the negative real interest rate is a big factor. So I mean, in my view, I think a hefty rate hike from Bank of Japan is the only solution to the yen weakness being contained. Of course, that is also a double-edged sword because when you hike rate, it leads to big unwind of carry trades, and global markets can come under pressure. That is where the dilemma of the central bank is. Now, rest of the major currencies are range bound, and they will take cues from jobs data and whether there is any further action from yen in the by the central bank, particularly Japan and US. As far as rupee is concerned, as we have repeatedly observed, below 95, where central bank interest is also strong, and importers, looking at the central bank bids, even the importers have started to buy more, for their hedges. And another thing that has happened is that the 1 year forward premium has fallen more than 1% from its peak, which is happening along with the spot falling to 95 levels. So that is also kept exporting away, making it slightly one-way market. So that keeps the dollar rupee slightly on the bid side, and with the global situation also again looking more uncertain than it was a couple of days ago, rupee likely to move towards a 95.50 once again. Of course, then we will wait for the jobs data and indications on how the US monetary policy is going to be in the coming month. Thank you.
Thank you, JK. And of course, the key highlights what Kevin Bosch has said in an interview with FT that September is going to be an alive meeting, and if inflation figures remain stubbornly high, they will be ready to act. This is being considered as some sort of a forward guidance, and markets are considering this as a bit of hawkish statement. On the other hand, the concerning aspect is on the geopolitics front. There's a dispute on the Strait and the tolls that can be levied on it, while we already discussed the attacks that has happened in the Saudi region by the Yemeni Houthis. Geopolitics is alive, even for the Fed and other central banks, the fight against inflation, that's alive. Uh, Currencies more or less range bound. Dollar rupee below 95 has seen interest from importers as central banks continue to buy dollars at below 95 levels. 1 year for premia has also fallen more than 1% from its peak. So fall in spot, fall in forward premium. So it keeps the exporters away, and hence the bid in the currency. That's it from us today. Thanks for listening. We will catch up on Monday with the fresh round of updates. Have a great weekend.